Well, greetings everyone and welcome to the Argonaut monthly video covering November 2025. Well, as always, you can read about the performance of the two Argonaut funds in our monthly fact sheets available on the award-winning Argonaut website. Now, November was something of a roller coaster month for markets when a significant correction in technology shares in the US over AI bubble concerns was subsequently drowned out by key Fed speakers backing a December rate cut. There was also a surprising revival of the Russia-Ukraine peace plans, and of course we had the much anticipated UK autumn budget. Now, we firmly believe that good capital allocation, which crucially includes saying no, is not only the secret to successful investment, but also to economic growth and good government. Crucially, if you want economic growth, economic progress, you have to accept a degree of Darwinianism, which is why capitalism and the discipline of the profit motive in sorting out the wheat from the chaff is the only method that works. Now, the title of this month's video is Other People's Money, and how spending other people's money is the most dangerous form of capital allocation. Now, this analogy was made famous by the economist Milton Friedman, and let's have a look at what he had to say.
You can spend your own money on yourself. And when you spend your own money on yourself, you're very careful of what you spend it on, and you make sure that you get the most for your dollar. You can spend your own money on somebody else. You give gifts to other people. You take people out to dinner. And when you spend your own money on somebody else, you're very careful that you don't spend too much. You try to keep down the amount you spend, but you don't worry very much about what the other fellow's getting from it. You don't pay anything like as much attention to the gifts you buy for other people as to the things you buy for yourself. Or you can spend somebody else's money, as when you're spending the government's money. I say the government's money, the taxpayers' money, which the government has control over. Now you're spending somebody else's money. Let's say you're spending your boss's money. You're out to lunch on a expense account, but you're spending it on yourself. You're very careful that you get good things for your money. You try to have a good lunch and pick the right things, but you're not very much worried about whether you get the cheapest. Spend all you want, and you'll be careless. Now, what happens when you spend somebody else's money on somebody else? You're a distributor of welfare funds. Well, you're interested in making your own life as good as you can, and most people have humane instincts and want to do the best they can, but you're not going to be anything like as careful in spending somebody else's money on somebody else. So there are 4 ways in which you can spend money.
The UK budget failed to live up to its billing, largely because the black hole in the public finances identified again by Chancellor Reeves' pre-budget and the basis for press speculation about a wide range of tax increases never existed, and at no point, according to the OBR, was there a budget shortfall of more than £2.5 billion. Reeves, nevertheless, decided to put up taxes anyway by £30 billion, largely through freezing income tax thresholds between 2028 and 2031 to pay for additional index-linked welfare payments, so spending more now and taxing more later. In a previous budget, Reeves had put up taxes by £40 billion, largely employers' national insurance and a tax on private education, to pay for above-inflation public sector pay rises. So the big idea from the UK Labour government, it seems, is to continue to reallocate capital, so far an additional 2.5% of GDP, from the productive and to the unproductive sector. It is diametrically opposed to the idea of economic growth or of fiscal discipline, despite using rhetoric suggesting otherwise. Now, we have previously written about the problems of the UK economy, and we're not going to repeat all of them here, but what they've all got in common is that more government is the problem rather than the solution. So consider now that government spending is above 46% of GDP, which is the highest it's ever been in peacetime, excluding COVID. Then consider how, according to official government figures, public sector productivity has flatlined since 1997, when government spending was just 35% of GDP, whilst private sector productivity is up some 48% over the same period. So productivity is output per unit of input. And of course, we've had many different technological advances, which has helped the private sector, which has at least taken advantage of those, to increase output per unit of input. Now, a good example of this lack of productivity growth in the public sector is in the NHS. So since 1997, government spending on our NHS has increased from £43 billion, or 4.6% of GDP, to a whopping £212 billion, or 8.4% of GDP. Yet service levels are widely recognised to have significantly decreased, while official productivity statistics show that NHS productivity is still 10% below its 2019 pre-COVID level. So in other words, the UK has been allocating a greater share of its national wealth to the least well-managed parts of the economy, where the excuse for poor performance is always a lack of resource rather than better management or more disciplined workers, which means that management is rarely accountable for its failings, the problem is never solved, and that the productive economy will eventually collapse under the weight of the parasitical public sector. And unlike in the private sector, where profit seeking is essential for economic survival, in the public sector, there is no economic penalty for malinvestment and inefficiency. The solution, therefore, can only be to allocate less of the national resource to government spending, and for government to solely focus on those areas of the economy where a private sector solution may not work. Now, 3 years ago, we made a stockumentary video about the dangers for investors of returning to a 1970s redux. I think we must now accept that we are wrong insofar as the current environment is worse, insofar as the 1970s was relatively unaffected by mental health welfare and uncontrolled immigration. So consider that 24 million people in the UK, or 1/3 of the population, currently receive benefits. 9.9 million people of working age, that's 1/4 of the working age population. Now, welfare spending has increased in the last 3 years from 259 billion, or 10% of GDP, to a predicted 324 billion, or 12% of GDP this year. The latest Family Resources Survey data shows that an astonishing 24% of working age adults are now disabled, up from 16% a decade earlier. So that's 3.9 million people more than a decade ago, a trend which the Institute of Fiscal Studies believes is unique to the UK. Moreover, a welfare system which is not only relatively generous but easy to manipulate serves as a magnet for unlimited migration, which accelerates the economic and fiscal crisis. As Milton Friedman also put it,
it's one thing to have free immigration to jobs. It is another thing to have free immigration to welfare. And you cannot have both. If you have a welfare state, if you have a state in which every resident is promised certain minimum level of income or a minimum level of subsistence, regardless of whether he works or not, produces it or not, well, then it really is an impossible thing.
In 1975, Margaret Thatcher famously said,
They've made the biggest financial mess that any government's ever made in this country for a very long time. And socialist governments traditionally do make a financial mess. They always run out of other people's money.
50 years later, we could add the caveat that this inevitable process accelerates without border controls. In response to speculation that OpenAI, the inventor of ChatGPT, had been negotiating with the Trump administration for government funding, Sam Altman, its CEO, took to Twitter or X to clarify a few things. So why is OpenAI, privately owned and supposedly worth $500 billion at its last valuation, in trouble? While OpenAI's ChatGPT, launched 3 years ago, has hardly evolved as a product, despite newer versions consuming significantly more computing power, whilst it's also struggled to convert free users to paid and even make money from paid subscribers. Now, the bigger problem is that OpenAI has already committed $1.4 trillion of investment through to 2033, which it does not yet have and is unlikely to be able to fund. So Altman claims that his company has $1 billion per month of run rate revenue, and that this will grow to $20 billion of annualized revenue by the end of the year, and an astonishing 200 billion, which seems like a finger in the air estimate by 2030. Now, these figures are based on ChatGPT, which many people think isn't even the best product nowadays, reaching 3 billion users, or nearly half the world's population, from 800 million today, and with 15 to 20% of users paying, up from 5% today, and maintaining its market share in chatbot compute, which is currently going down from 80%. So this is despite no obvious profitable consumer applications and growing competition. Microsoft, for example, which owns 27% of OpenAI, is tellingly now using competitor Anthropic models, which it considers superior. And Google has just launched Gemini 3, which again, many people believe is superior. So not only is OpenAI's business model highly capital intensive, it's reported to last quarter to have lost $4 for every $1 of revenue, although half of those losses are supposedly non-cash stock option remuneration. But it's also yet to demonstrate scalable economics. In other words, its margins have not improved as a company has grown, given the exponential cost of compute. So the cost of delivering its service is going up rather than down, which is not a good sign. Now, in September, it was reported that OpenAI now projected that it will burn 115 billion of cash through to 2029. That's up an astonishing 90 billion from 25 billion it previously said it would burn, with Sam Altman telling his employees that their business plan was the most capital intensive startup of all time. No kidding, but I suspect that was nothing to be proud about. An investment bank recently estimated OpenAI's funding gap to be $200 billion. But in our opinion, given that the investment bank's model has some heroic assumptions over revenue growth, the funding gap is likely to be a multiple of $200 billion, which means, given the availability of private equity capital and the poor economics, that barring a miracle, OpenAI will either fail or seek a government bailout. Now, so far, only Nvidia has shown that it can make money from AI. And if customers cannot make money from Nvidia's GPU chips, then those customers will either stop spending or look elsewhere for cheaper solutions, as Google is now doing with its making its own chip available to Meta to use in its AI. So whilst financial markets can stomach near-term losses, they're not just short-sighted, they can stomach near-term losses from investment. The lack of AI-specific product revenues at hyperscalers should now be concerning. So in its Q2 2025 earnings call, Microsoft said that it had $13 billion of AI product revenues on Azure Copilot Fabric on an annualized run rate basis. Now, this was up 175% year on year. So this sounds impressive, but it needs to be compared to the 80 billion of AI specific capex Microsoft has spent in 2024 and 2025. And in any case, management has now been shy about what AI specific revenues now are and have ceased to report this. Moreover, according to press reports, most of this 13 billion of specific AI run rate product revenues actually come from OpenAI spend on Azure, which Microsoft is giving away either at cost or making a slight loss on. So, a recently published research paper estimated that the hyperscalers, Microsoft, Amazon, Alphabet, and Meta, currently generate aggregate run rate revenues of just $29 billion on $332 billion of capex in the last 2 years. So, with such anemic revenue return on capex of, on average, just 8%, and obviously a lot less if you strip out those OpenAI revenues to Microsoft, which are delivered below cost. A prudent CEO spending would review their investment plans and either spend a bit less or find a cheaper solution, at least until they could demonstrate that there is some demand for these products. Now, whilst cloud computing has historically been very profitable with Amazon Web Services, Microsoft Azure, and Google Cloud earning 60 to 70% gross margins, the economics of AI server renting are rather less compelling. Now, recent disclosure from former software company Oracle, which for reasons unknown to most rational investors has decided to get into the business of renting out AI servers, reveals that Oracle's gross profit margins from GPU rentals over the last 5 quarters have been on average 16%, which is a significant dilution of its overall software-based gross profitability. Now, unlike Oracle, the pure play neo cloud companies, which are where their business is solely based on renting out GPU capacity, so this is the likes of CoreWeave, Nebius, Lambda, do not have higher margin software revenues to subsidize their AI business. And their business really just acts as a swing supplier of commoditized AI compute. So these are really marginal businesses which are going to be the first to get hit in the downturn. Now, with Nvidia aiming to launch new products annually rather than every 2 years previously, this brings us to the depreciation debate, where most companies that own GPU chips depreciate them over 5 to 6 years. Yet their useful life based on rental yields would suggest that 2 years would be more appropriate. So let's look at why we think that. So the cost of renting out Nvidia GPU chips continues to fall, with the hourly rate of, for example, the H100 chips, which were launched in October 2002, falling from $8 per hour when they were released to just $1 currently. So that's a really drastic fall in the economic value in just 3 years for these Nvidia chips, which cost $30,000 in 2022. So really, no matter if Nvidia says that these chips are still being used 5 or 6 years later, they may still be being used, but their economic value is very low compared to what they were bought for. So this means that all of the hyperscalers are vastly exaggerating group profits through under depreciating their AI capex. So if you are spending 100 billion and you're depreciating that over 10 years, the charge is just 10 billion a year to profits. If the value of or the true economic life of those assets was just 2 years, then you would have to take a 50 billion depreciation charge rather than a 10. So a massive, it makes a big difference to profitability. And that's why the hyperscalers, or the likes of Amazon, Google, Meta, and Microsoft, are now actually outsourcing their capex requirements to the neo clouds, who are originally thought to be competitors, or leasing capacity through special purpose vehicles backed by private credit, which being last to the party, financing the most marginal asset based on the collateral value of rapidly depreciating GPUs or contracts which the hyperscalers can wriggle out of if they change their mind, will likely see these alternative asset managers in private credit caught up in the coming crisis. Now, Jeffrey Goodlack, who is a noted bond investor, recently noted that unlike public credit, where bonds trade and are marked to market, private credit seems to either have two prices, 100 or zero. In other words, you don't know about the problem and the deteriorating in credit until it's too late. And I think it's likely that we're going to see a lot of zeros from data center overbuild. Now, finally, Nvidia, which has become the world's most valuable company, selling a product from which none of its customers are able to make any money, a curious phenomena, will be the last to admit any problem and is naturally desperate to extend the duration of the misallocation by financing its customers through equity stakes and other forms of vendor financing. This robbing Peter to pay Paul artificially inflates the bubble further so that when it eventually pops, the fallout will be systematic rather than just idiosyncratic. Of course, aggressive Fed easing could inflate this bubble further, but make no mistake, AI investment, and remember it takes 3 years to build an AI data center, is running way ahead of revenues and profit, and this is now a horrendous misallocation of capital from what were previously some of the world's best companies. Now, at Argonaut, our business is not spending, but largely managing other people's money. And we remain very grateful for the trust and support we receive from all of our investors. Now, our funds price, and we allow our investors to buy or sell our funds every working day. And in that way, there's a lot of transparency, demonstrating that we are accountable on a daily basis. And we're happy with that, since it certainly drives out any complacency and means that we are highly motivated in what is a very competitive industry to achieve consistent positive results for our investors. Now, we will be back in the new year. Until then, and in advance of the festive period, all of us at Argonaut thank you for your support, and we wish you and your king tidings of comfort and of joy.